Let's dive into reversal patterns, the hanging man and the hammer. Hearing reversal pattern may lead you to think of an old trend ending abruptly and then reversing to a new trend. This rarely happens. Trend reversals usually occur slowly, in stages, as the underlying psychology shifts gears. A trend reversal signal implies that the prior trend is likely to change, but not necessarily reverse. The prior trend could also convert into a period of sideways price action. The previous trend can resume after a short period as well. Reversal patterns can be best described as trend change patterns. An important principle is to place a new position based on reversal signal only if that signal is in the direction of the major trend. Hammer and hanging man lines. The actual Japanese word is takui. The word means something to the effect of trying to gauge the depth of the water by feeling for its bottom. The hammer and hanging man can be recognized by 3 criteria. 1. The real body is at the upper end of the trading range. The color of the real body is not important. 2. A long lower shadow should be twice the height of the real body. 3. It should have no or a very short upper shadow. The longer the lower shadow, the shorter the upper shadow, and the smaller the real body, the more meaningful the bullish hammer or bearish hanging man. It is more bullish if the real body of the hammer is green, indicating that the market sold off sharply during the session and then bounced back to close at or near the session high. And more bearish if the real body of the hanging man is red, indicating the close could not get back to the opening price level. The key differences between a hammer and a hanging man is that a hammer is significant if the trend context is downtrend, and for hanging man the trend should be up. A hammer is a bullish reversal signal, whereas the hanging man is bearish reversal signal. It is important that you wait for confirmation candle after a hanging man. The general principle is the greater the gap down opening the next day, the more likely chance of reversal. If the next day close is red body candle with lower close than the hanging man session's close, then it is a good reversal signal. Conversely, for a hammer confirmation, next day candle should be a gap up candle. The higher the gap up, the better. Also, if the next day candle closes in green with real body, better will be the signal. The hammer and hanging man candlestick patterns can fail under certain conditions, primarily when the broader context or confirmation signals are ignored. Here's when and why these patterns may fail: lack of confirmation. Hammer failure: if the candlestick following the hammer is not bullish, e.g., it closes below the hammer's low, the pattern fails to confirm the reversal. This can happen when the selling pressure remains dominant despite the initial buying interest shown by the hammer. Hanging man failure: if the candlestick following the hanging man is not bearish, e.g., it closes above the hanging man's high, the reversal does not materialize. Continued buying pressure indicates the uptrend is still strong. Misinterpreted context. Trend context: hammer: if a hammer forms during a sideways market rather than a clear downtrend, it loses its reversal significance. Hanging man: if a hanging man appears during a consolidation phase instead of a clear uptrend, it may not signify a reversal. Market environment: in strong trending markets, bullish or bearish, these patterns may fail due to the overwhelming momentum in the prevailing trend. Ignoring volume: both patterns are more reliable when accompanied by significant volume, indicating strong participation from buyers, hammer, or sellers, hanging man. Low volume may signify a weak or false signal. Every candlestick pattern should be treated as guidelines only, they are not rigid rules.